You hear the promises all the time, right? Stability, growth, opportunity. But what if the whole financial system has a hidden agenda? In this explainer, we're going to pull back the curtain on some centuries-old tricks that are quietly shaping your wallet today.
Okay, let's just dive right in. The core idea we're digging into is this. For literally centuries, governments have been using the same playbook of financial tricks. And the goal? It's always the same. To quietly shift wealth and power into their own hands, usually at your expense.
And that's the big question I want you to keep in the back of your mind through all of this. As we go through these historical patterns, just ask yourself, are these exact same tricks, maybe just in a modern disguise, still hitting your bank account today?
All right, so let's start by uncovering what is basically a centuries-old secret. It's a hidden pattern in history that has shaped economies from way back in ancient times right up to this very moment.
The first one, the simplest, the oldest trick in the book, is inflation. Now, we're all taught to think of inflation as just this natural economic thing that happens. But the source material here frames it completely differently, as a deliberate choice. See, when a government needs more money than it can get from taxes, it really has two options. It can raise taxes openly, which, nobody likes, or it can quietly, secretly devalue the currency.
And this is not a new idea. This goes all the way back to ancient Rome. And you'd be shocked at how direct the line is from their ancient coins to your modern bank account.
So this is what inflation looked like back then. It was called currency debasement. Imagine you have a pure silver coin. The government takes it, melts it down, mixes in a bunch of cheap metal like copper, and then stamps out two coins that look exactly the same. Boom. It just doubled its money, but in the process, it just cut the real value of your money in half.
And this is where you really start to see the pattern. In 3rd century Rome, emperors needed cash for wars, so they started shaving the silver out of their coins, until the denarius was basically just a copper coin with a thin silver wash. Fast forward to the Middle Ages, kings would force merchants to lend them money, and then, if they paid them back at all, it was often with devalued currency. And today, what happens now? Well, central banks create new money electronically, out of thin air, which pumps up the total supply and makes every dollar, euro, or pound you've saved worth a little bit less.
And check out the language they use to disguise the trick. It's fascinating. On the left, you've got the Roman emperor insisting, hey, a denarius is a denarius. On the right, you have modern central bankers calling it quantitative easing to provide stability. But the reality? It's the exact same thing. It's a silent, hidden tax. Your savings buy less, and the government gets to pay its bills.
So things started to evolve, right? The tricks got a lot more sophisticated. They stopped just messing with the coins and started engineering the entire system to be a wealth machine, designed specifically to transfer wealth from one group to another.
A perfect example of this? Look no further than the Bank of England back in 1694. Here's how it worked. 1. The government needed a ton of money for wars with France. 2. Wealthy investors bought government bonds, which is just lending the government money. 3. In return, the government guaranteed them steady interest payments on those bonds. So step 4 is the big question. Where did the money for those interest payments come from? Well, it came from taxes on everyday stuff like beer, salt, and cloth. Taxes paid by the general public. So think about that. The public was paying taxes to fund the interest that was going directly into the pockets of wealthy bondholders. It was a wealth transfer system, just dressed up as national finance.
Now, let's fast forward to today. That basic model has just gotten way more advanced. The tricks are the same in principle, but now they're buried under all these layers of modern finance and complex jargon.
Let's take deficit spending, for example. Governments run up these massive debts by issuing bonds, and we're told it's for public services, for infrastructure. But a huge chunk of that borrowing just goes to paying off old debt, and the benefits go to the bondholders. Meanwhile, the bill? Well, the bill eventually comes due for you and me, for future taxpayers, through either higher taxes or more inflation.
This quote just says it all, doesn't it? It perfectly captures what happened with the modern bailouts. Think back to the 2008 financial crisis. Banks that made these incredibly reckless bets were suddenly called too big to fail. So what happened? They were bailed out with taxpayer money. So the banks got to stay private and keep all their future profits, while the public, we, got stuck with the bill for their losses. The gains were privatized, the losses were socialized.
And hey, let's talk about something like quantitative easing. Central banks printed trillions of dollars, which drove up the prices of assets like stocks and real estate. But who actually owns those assets? Well, this chart tells the whole story. The top 10%, they own pretty much all of it, like 90%.
So while the official story was that this was saving the economy, what it really did was funnel a massive amount of wealth to the very top.
You know, even something that feels super safe, like a pension, can be part of the game. A lot of government-run pension systems aren't actually saving and investing your money. Nope. They're spending your contributions today and just leaving an IOU, a promise that future generations of taxpayers will be there to pay for your retirement. The source material calls this a generational Ponzi scheme that can only work as long as the population and the economy just keep growing forever.
And here's the real kicker. All this complexity, it's not a bug, it's a feature. Tax codes that are thousands and thousands of pages long, financial products that literally nobody can explain, it's not an accident. It creates a system that's so confusing, so opaque, that it's almost impossible for an average person to figure out where the money is actually going. The complexity is just camouflage.
Okay, so after all that, you're probably asking, how on earth do I navigate this system? In this last section, we're going to focus on exactly that, seeing the game clearly and maybe protecting your wealth.
You know, the single most powerful tool you have is recognizing the pattern. It doesn't matter if it's a Roman emperor secretly mixing copper into a silver coin or a modern central bank printing money on a computer screen, the mechanism is exactly the same. The currency gets devalued, the state benefits, and the person saving money gets hurt. History gives you the blueprint to see the trick coming.
So here's your takeaway toolkit, straight from the source material. First, always look past the headline. When you hear about a new government policy, ask yourself, who really profits from this? Second, focus on building wealth in real assets. Things that can't be easily devalued by a government just deciding to print more money. And third, and this is a big one, just maintain a healthy dose of skepticism. Systems are designed to protect and perpetuate themselves, not necessarily to work for you. Financial education is your best defense.